Here now are a couple of growth and income stock suggestions, recommendations, whatever you want to call them, that our growth and income stock strategist Todd Bunton has uncovered for your consideration. This one is 3M. I mean, it's a company that's been around for a while. They make tapes, adhesives.
That's right, yeah. Founded in 1902, actually. And people are probably familiar with Post-its, Scotch tape, Scotch-Brite pads.
Right.
But that's in their consumer division. That's actually their smallest division. So that's about 14% of their total sales. They have an industrial segment, which is actually their largest, which is adhesives and things, but they sell it to companies like body shops and industrial users. They have a safety and graphics division, electronics and energy, healthcare. So they're in a lot of different areas, pretty diversified, and diversified globally. About 36% of their sales are from the U.S. The rest is outside of the U.S. So they're a global manufacturer, very diversified. And you think, you know, the global economy is kind of struggling right now. Are these guys struggling? Not really. They actually just delivered record fourth quarter sales and earnings per share. And it actually beat the Zacks consensus estimate too, which prompted analysts to revise their estimates higher, sending it to a Zacks rank of 2. Yeah,
they've been a tried and true performer through all kinds of economies.
Yeah, because they're so diversified, they have pretty much stable revenue and earnings, about as stable as you can get, you know, in this space. So, yeah, they're definitely a reliable company. If they don't beat, then they usually come in within a penny or two of the Zacks consensus estimates. So, yeah, very stable. Which you know, if you're a little uneasy about where the stock market is right now and where the economy is, this is a nice kind of safer growth and income type name to go into. There's Zacks rank of 2, which I said they have good earnings momentum, and based on consensus estimates, analysts are expecting about 11% earnings per share growth this year, 11% growth next year. It's a nice low double-digit, pretty steady earnings growth here, and a good income story as well. They pay a dividend that yields 2.7%, and they've increased that. To talk about stability, they've increased that for 55 consecutive years, which is absolutely phenomenal. And 2.7% yield, and I brought a chart with me. Since the year 2000, they've increased their dividend at about an 8% compound annual rate, which means it doubles about every 9 years. And you can see in 2014, actually it's late 2013, they announced a pretty significant dividend hike, actually a 35% dividend increase. And that's because they generate strong, steady free cash flows, they have a solid balance sheet, and they're very shareholder friendly. So good income to go along with that solid growth, and all at a pretty reasonable price. They trade a little less than 18 times forward earnings. Not a screaming value here, but you know, you're paying for the stability, you're paying for that wonderful brand and the nice moat they have, and for a good solid dividend yield too. So there's a lot to like in this name, I think.
All right, and then you've uncovered this insurance company, Maiden Holdings.
Yeah, they're quite a bit smaller. They're a small cap, and market cap around $873 million. But a Zacks rank of 2, they're basically an insurance company's insurer. So that's called the reinsurance business. They do non-catastrophic, customized reinsurance products. But it's an interesting space to be in right now. The insurance industry ranks very high based on earnings momentum with the Zacks industry rank. And like I said, they're a number 2. They've delivered 4 consecutive positive earnings surprises, including a nice beat on February 19th. And they're seeing improved underwriting, meaning, you know, what they pay out in claims as a percentage of premiums is improving for them. So they're actually generating an underwriting profit. And another thing with insurance companies, if you think about it, when you pay in your premiums every month, they usually invest that in fixed income securities. So they're in things like bonds. Of course, rising interest rates hurt the value of bonds. But, you know, I think that those fears are a little overblown here. Which I'll get to in a second when you look at their valuation. But if you think about it, rising interest rates also means they can invest in higher and get higher rates of return as well. So it's kind of a trade-off there, I should say.
Yeah, insurance companies' investment portfolios never seem to diminish by any great percentage.
Yeah, they're not in risky assets. They've got to be in stable things, especially an insurer like this, because they're going to pay out claims in a pretty short time frame. So yeah, they're heavily regulated, and they've got to be in safe instruments. And yeah, you have interest rate risk with bonds, but I think that's overblown, which I said I'll get to in a second. But 4 consecutive positive earnings surprise, nice earnings momentum, and you can see analysts have revised their estimates significantly higher over the last several months, sent it to a Zacks rank of 2. You can see a nice upward slope in 2015 consensus estimates. And based on those estimates, analysts expect 21% earnings growth this year and 16% growth next year. So you've got good growth, very good income. They pay a dividend that yields 3.7%.
Wow.
One of the best of a small cap insurer that I've seen. And since they went public in 2008, they've increased their dividend at a 14% compound annual growth rate. So
Interesting.
Yeah, so very shareholder friendly. They only pay out about 30% of their earnings in the form of dividends, so there's plenty of room to continue raising that in the future. And then valuation, which is, I think, really attractive here. They trade at just 8 times forward earnings and about 1.1 times tangible book value. And I think a lot of that is because of the interest rate risk fear, but you know, I think that's obviously priced into the stock. And you know, and if you look, since the Fed has started tapering, the 10-year hasn't really moved that much higher. So.
Right.
So if you know that interest rate risk isn't as bad as people think, then there could be a lot of upside potential in this name. And at the very least, you're getting a 3.7% dividend yield.
Sure. Okay. Own either one of these two?
I do not.
All right. Check out other stock picks and stock picking strategies where? At our website, zacks.com, if you're not there right now watching this video. With Todd, I'm Terry Ruffalo.